Okay, so let's dive in.
Sounds good.
Imagine inheriting a huge stock portfolio,
Okay.
but then a small little timing mistake
Uh-huh.
costs you a big chunk of it in
Yeah.
taxes. That would be a
A
nightmare.
total nightmare.
And that's exactly what we're going to be looking at today.
Yeah.
The world of estate planning and
Yeah.
taxes,
Yeah.
specifically in separate property states.
Yeah. This can get tricky.
Sure.
We're using an article today called How Community Property versus Separate Property States Can Be a Tax Dream or a Tax Nightmare Part 4.
Wow, that's a mouthful.
Yeah, it is a mouthful.
Okay.
From the Skull Financial Group.
Okay, great.
And
Ready to dive in.
yeah, so basically it highlights
Mhm.
how transferring assets between spouses
Okay.
in separate property states can have huge tax implications,
Okay.
especially when one spouse is terminally ill.
Oh, wow. Okay.
So that's kind of the main thing we're going to be looking at today.
Okay, so before we get into that,
Sure.
can you just remind us?
Yeah.
What makes a separate property state different from a community property state?
Yeah, so basically in a separate property state,
Mm-hmm.
anything you owned before marriage
Yeah.
is considered yours alone,
Okay.
versus community property states generally view assets acquired during marriage as jointly owned by both spouses.
Okay, so that makes sense. So if you get married in a separate property state and bring in like this valuable stock portfolio,
Right.
that stays yours even if things go south.
Yep. Exactly. And that distinction is really important when
Sure.
we start talking about estate taxes
Mhm.
and something called the step-up in basis,
Okay.
which is a real game changer when you're inheriting assets.
Big time.
Next up.
Step up basis.
Yeah.
That sounds kind of complicated.
It sounds more complicated than it is.
Right.
Basically, when you inherit something,
Mm-hmm.
the value used to calculate any potential taxes
Mm-hmm.
is adjusted to the market value at the time of the original owner's death.
So like, let's
Oh.
say you inherit stocks your grandmother bought for $10,000,
Okay?
but now they're worth $100,000.
All right.
You get like a free pass on that 90 grand gain.
You got it.
Wow.
That's the step-up in basis.
Okay.
So if you sell those stocks right away,
Uh-huh.
you wouldn't owe any capital gains taxes on that $90,000 profit.
Wow. Okay. That's huge.
Yeah, it's a huge advantage.
Huge advantage.
There's-
There's always a but.
There's always a but.
I knew it.
The article mentions a potential catch in separate property states
Uh-oh.
called the boomerang rule.
Okay, what's that all about?
This is where things get tricky.
Okay.
The boomerang rule,
Uh-huh.
or officially Internal Revenue Code, Section 1014E,
Oh, wow.
basically says
Mhm.
if you gift an asset to someone
Okay.
less than a year before they die,
Uh-huh.
the inheritor doesn't get the step-up in basis.
So the IRS is on to people
Oh, yeah.
trying to like pull a fast one?
Big time, yeah.
Okay.
They're wise to that.
So to show just how costly this mistake can be, the article has this case study
Right.
where there's a younger, healthy spouse
Okay,
and an older, terminally ill spouse.
got it.
Each of them has a separate $1 million stock portfolio.
Right.
They bought it way back when for $100,000.
Okay,
And they also have a jointly owned $1 million portfolio.
okay,
Also purchased for $100,000, but
Yeah.
they got that one after they got married.
got it.
So
Makes sense.
the healthy spouse, thinking they're being clever,
Uh-huh.
transfers their $1 million portfolio to their terminally ill spouse,
Okay,
hoping to get that step up in basis later.
right.
What happens?
Well, all depends on the timing.
Oh, boy.
If the terminally ill spouse passes away less than a year after the transfer,
Uh-huh.
bam, you get hit with the boomerang rule.
Ouch.
No step-up in basis.
Oh, no.
They're stuck with that original $100,000 cost basis.
So what kind of tax hit are we talking about here?
Well, in this scenario,
Mhm.
they'd be facing a pretty hefty capital gains tax bill
Okay.
on that $900,000 profit.
Almost $215,000,
Wow.
according to the article's calculations.
That's a huge difference.
It's massive. What if they had just waited and made the transfer like over a year before the spouse passed away?
Then they would have avoided the boomerang rule completely.
Oh.
Step-up in basis would have applied,
Okay.
and they wouldn't owe any taxes on the sale of that stock.
Wow, so timing is everything.
Timing is everything.
Now, what about that jointly owned portfolio?
Right.
Would the same rules apply?
Yeah, but with a twist.
Oh, great.
If they transfer that joint account
Mm-hmm.
to the terminally ill spouse
Mm-hmm.
less than a year before their passing,
Yeah.
the boomerang rule would still apply.
Oh, so no full step up.
No, unfortunately, no.
All right.
Because of the rule,
Uh-huh.
they only get a 50% step up,
Wow.
meaning they'd still be liable for capital gains taxes
Mm-hmm.
on the remaining profit.
That's still a pretty big tax bill, right?
Over $107,000 to be precise.
Wow.
But just like with the separate account.
Mm.
If they had transferred the joint account
Mm-hmm.
more than a year before the terminally ill spouse passed away,
Then they get the full step up.
full step up.
No taxes.
No taxes.
Wow. This is
Wild.
this is fascinating.
Yeah.
It's crazy how
Seemingly small decisions.
can have such a big impact.
Huge implications. Yeah.
So what if the terminally ill spouse had kept the asset in their own name the whole time?
In that case,
Mm-hmm.
surviving spouse would automatically receive a full step up in basis,
Yep.
regardless of when the asset was purchased.
So sometimes the simplest approach
Sometimes.
is best.
Yeah.
Okay, well, this makes me wonder,
Yeah.
do these principles only apply to stock portfolios?
That's a great question.
What about like real
Yeah.
estate or businesses?
Yeah, that's an excellent question.
Okay, so I guess we're going to find out.
We'll explore that next.
More fascinating insights
Oh, yeah?
coming up.
Yeah.
You're right. It makes me wonder, too,
Yeah.
what if we're talking about like a rental property instead of a stock portfolio?
Okay.
How would the boomerang rule play out there?
Well, let's say you own a rental property in a separate property state.
Mm-hmm.
You bought it years ago
Okay.
for $200,000.
Okay.
Now it's worth $500,000.
Okay.
If you transfer that property to your spouse
Yeah.
less than a year before they pass away,
Uh-huh.
the same problem arises.
They don't get the step up.
Exactly.
So they inherit it, but they're stuck with that original $200,000
Mm-hmm.
cost basis.
Exactly. So if they decide to sell the property later on,
Yeah.
they'd be responsible for paying capital gains taxes
Mm-hmm.
on that $300,000 profit.
Yikes.
Yeah.
But if they had inherited it directly from you
Right.
without that last-minute transfer,
Right.
they would get the step up
They would.
to $500,000 and
Yep.
avoid that huge tax bill.
Huge difference.
That's huge.
It is. It really highlights
Yeah.
how important it is to think about these things
Mm.
in advance.
Yeah.
The same logic applies to other assets, too,
Okay.
like a family business.
Uh-huh.
Transferring ownership
Yeah.
less than a year before death
Yeah.
could create a significant tax burden
For your heirs.
for your heirs. Exactly.
So the boomerang rule isn't just about stocks. It's
Mhm.
about understanding.
It's about the big picture,
Yeah.
the potential tax implications
Yeah.
of transferring any valuable asset.
This is making me think about my own estate planning.
Yeah, it's a good reminder
Mm-hmm.
that these rules
Yeah.
can be quite complex.
It's not something you want to try to figure out on your own, is it?
Definitely not.
Okay.
This is where working with professionals,
Yeah.
like a qualified financial advisor
Uh-huh.
and an estate planning attorney,
Mm-hmm.
becomes absolutely essential.
Yeah.
They can guide you through all the intricacies of the law,
Mm-hmm.
especially in separate property states,
Okay.
and help you develop a plan
Yeah.
that minimizes your tax liabilities.
Mhm. So it's about more than just saving money on taxes, right?
It's way more than that.
It's about protecting your legacy
It is.
and making sure your loved ones inherit as much as possible.
Absolutely.
This has been so insightful.
Good.
What's the one key takeaway
Hmm.
you would emphasize for our listeners today?
I think the most important thing is to be proactive.
Okay.
Don't wait till a crisis hits
Yeah.
to start thinking about estate planning.
Right.
The earlier you start,
Mm-hmm.
the more options you'll have,
Okay.
and the better prepared you'll be.
To make informed decisions.
Exactly.
That's great advice.
Thanks.
Don't wait. Get started now.
Yep.
And for those who might be feeling overwhelmed
Right.
by all this, what
Yeah.
should they do?
Don't hesitate to reach out to a professional.
Okay.
They can help you navigate all these complexities
Yeah.
and create a personalized plan.
That meets your needs.
Exactly.
Knowledge is power,
Absolutely.
especially when it comes to protecting your wealth.
Couldn't agree more.
Thanks for shedding light on these important concepts today.
My pleasure.
It's been really eye-opening.
Good. Glad to hear it.
This is a lot to think about.
It really is.
We've uncovered so many important insights.
Yeah, and today we really focused
Yeah.
on this very specific scenario
Mhm.
with the terminally ill spouse.
Right.
But
Yeah.
these principles,
Mm-hmm.
they apply
Yeah.
more
Broad-
broadly.
So even if someone isn't
Right.
facing that exact situation,
Exactly.
they can still get a lot out of this.
Absolutely. The key is just thoughtful planning
Mm-hmm.
and understanding these nuances
Yeah.
of these separate property laws.
It makes a big difference.
It can make a huge difference. Yeah.
And this boomerang rule
Yeah.
really proves that.
It really highlights that.
Yeah.
Yeah. It could be
Yeah.
easily overlooked
Yeah, if you're not familiar with it.
if you don't know the rules.
It's important to not only have a will,
Right.
but also to understand these asset transfers and the timing of it all.
The timing is huge.
So if someone's feeling overwhelmed,
Yeah.
what should they do?
Don't put it off any longer.
Okay.
Reach out to a qualified financial advisor
Mm-hmm.
and an estate planning attorney
Okay.
who specializes in separate property states.
Okay.
They can help you put together a plan
Yeah.
that minimizes potential tax burdens
And protect your legacy.
and protect your legacy.
It's worth it.
It is.
That peace of mind.
It really is.
Knowing that you've done everything you can.
Absolutely.
I know I'll be calling.
Yeah, it's a good idea.
It's a decision you won't regret.
You won't.
Estate planning isn't just for the wealthy.
No, it's for everyone.
Well said.
Thank you.
Well, I think we've covered a lot today.
Yeah, I think so.
This has been a fascinating deep dive
It has been.
into the complex world of estate planning
Always a pleasure.
and taxes.
Yeah,
So to our listeners,
Yeah.
we hope this has been insightful
absolutely.
and empowering.
Yeah,
Remember, knowledge is power.
it is.
And with the right guidance,
Yeah.
you can navigate these challenges
Cool.
and create a legacy that reflects your values and protects your loved ones.
For sure.
Until next time, keep diving deep.
See ya, T.